It was projected to be a washout quarter for India Inc. with a 68-day forced shutdown of business activities during the complete lockdown of the nation. Let's do a three-point analysis of what the overall picture looks like with the earnings reported so far and what is the outlook going forward. 1. Earnings shrink in Q1, outlook improves. Well, Elara Capital has reported that Nifty 50 saw a sharp decline in the bottom line and top line in Q1FY21 with contraction in net sales, EBITDA and PAT. Now, in an earnings review report by Motilal Oswal, financials, telecom, oil and gas and healthcare should contribute to the incremental growth in the Nifty profits in FY21. And on the other hand, autos, capital goods, cement, metals and utility sectors are expected to be a drag going forward from here. Now, excluding the banking and the finance sector, Motilal Oswal Financial Services expects Nifty in FY21 profits to remain flat year on year on the back of 13% decline in the FY20 numbers. 2. India Inc. cuts costs in Q1. Corporate India's focus was on cushioning themselves from the unprecedented impact of the world's strictest lockdown to contain the pandemic. Most of the companies undertook stringent cost control measures to protect their bottom line this time and also to arrest the decline in the operating profit in Q1. Experts say that while most of the fall in the initial costs was the result of a lower economic activity, however, companies are likely to reevaluate the efficacy of their cost line items and significant cost reductions are also likely to stick even when the normalcy returns. 3. How did the various sectors perform? Well, COVID-19 induced lockdown showed up starkly in the performance of all sectors in Q1 FY21, with the exception of healthcare and IT, which delivered positive bottom line growth. For the agrochemicals, if you see an early start to the sowing season, initiatives by the central government to support the agri sector, as well as a favorable monsoon have all resulted in agri input companies reporting better than estimated performance as well. Now, the auto sector posted weak earnings with a sharp volume decline year on year. Majority of the OEMs and suppliers also reported losses due to the continued demand weakness, as well as it was further impacted by the production side ramp-up issues and the migrant labor availability issues as well. Now, in aviation, the domestic passenger demand was down 93% in Q1, primarily on account of COVID-19, as air travel was halted from April until mid-May, which affected the seasonally strong quarter. Now, for banks, the slippages were lower due to the asset classification freeze benefit, and also that was provided by the regulator during the COVID-19 crisis. Now, moratorium 2.0 numbers reduced significantly for a few large banks, which actually came in as a positive surprise. So that's a positive indication. For most IT companies, the deal wins were robust, that is despite the pandemic-led uncertainty, while improving deal pipeline provides a good revenue visibility in the medium term as well for most of the IT companies. Now, pandemic has led to a faster digital adoption as well. That's again going to be a watch out factor. Although the top line of the pharma companies remains muted during the quarter, EBITDA did see strong growth on account of lower overheads and the R&D expenses. And as the lockdown restrictions ease, the domestic business is expected to even pick up in H2 of FY21. Also, companies with a presence in the API segment saw healthy growth in the segment as buyers look to diversify and de-risk supply from China. Now, consumers prioritized health and hygiene and nutrition products given the COVID-19 outbreak, and hence these kind of products have actually seen a spike in demand among the entire FMCG companies. Now, near-term outlook or demand outlook may see some challenges, that is due to the sporadic lockdowns that we are seeing and the rising COVID-19 cases in the hinterland. Paint companies, especially their sales contracted in the range of 43 to 59% as April was a washout month in terms of sales. Softer raw material prices in Q1 definitely led to a gross margin expansion for most of the companies in the sector. Now, no price correction was taken in Q1 and companies also do not expect any pricing action in Q2 going forward from here.